The Australian funds management industry should soon gain access to a far larger market thanks to the passage of the Asia Region Funds Passport legislation in late June. The passport enables a fund registered in one country to be sold to retail investors in other participating countries, which include Australia, Japan, Korea, Thailand, and New Zealand. Federal Revenue and Financial Services Minister Kelly O'Dwyer said the passport would provide Australian fund managers with an opportunity to gain economies of scale through exposure to Asia's growing middle class. She added that while Australia has one of the world's largest and most sophisticated funds management industries, looking after $3 trillion Australian dollars of assets under management, only around 4% of these funds belong to investors from outside Australia. The bill gives effect to the passport's Memorandum of Cooperation, signed in 2016 by the 5 participating countries. However, while the passage of the Corporations Amendment Bill is considered an important milestone, several associated regulations are currently under consideration. For example, the Financial Services Council has identified that tax reforms to complement the passport are now urgent. Australia, unlike other countries in our region, has a complicated non-resident withholding tax regime, which means we will not be able to compete with countries where this rate is zero, cautioned the FSC's CEO, Sally Lone. The passport was one of the recommendations of a 2009 review by veteran fund manager Mark Johnson to position Australia as a global financial centre. ASIC has put financial advisors who advise SMSF trustees on notice after reviewing a sample selection of client files. The regulator reviewed 250 files, randomly selected based on ATO data, and assessed compliance with the Corporations Act Best Interest Duty and related obligations. ASIC found some fault in the majority of cases, with Deputy Chair Peter Kell moved to comment that the financial advice sector had significant work to do to lift their performance in this area. According to ASIC, the non-compliant advice ranged from record keeping and process failures to failures likely to result in significant financial detriment. In 10% of files reviewed, the client was likely to be significantly worse off in retirement due to the advice, while in 19% of cases, clients were at an increased risk of financial detriment due to a lack of diversification. Commenting on the report, Dante De Gori, CEO of the FPA, said SMSFs were not suitable for everyone. There is no doubt that these results will focus the efforts of code monitoring bodies, once approved, on the proactive supervision of SMSF advice. This is a growing sector, and good advice is imperative to ensure the best outcomes for those who choose an SMSF as the vehicle to manage their retirement savings, he said. The FPA supported the practical tips released by ASIC and encouraged all financial planners giving SMSF advice to review their handling of the role and obligations of SMSF trustees. ASIC's review into credit card lending in Australia has found that 18.5% of consumers are struggling with credit card debt. The regulator reviewed 21.4 million credit card accounts opened between July 2012 and June 2017. The report, released in July, found that while credit cards offer flexibility, they can present a debt trap for more than 1 in 6 consumers. In June 2017, there were almost 550,000 people in arrears, an additional 930,000 with persistent debt, and a further 435,000 people repeatedly repaying small amounts. According to the ASIC review, consumers are also being provided with credit cards that don't meet their needs. For instance, many consumers carry balances over time on high interest rate products, when lower rate products would save them money. ASIC estimates that these consumers could have saved approximately $621 million in interest in 2016-17 if they had carried their balance on a card with a lower interest rate. On 16 December 2015, the Senate Economics References Committee released its report relating to credit card interest rates and informed choice in the Australian credit card market. A primary concern of the committee was that too many Australians are revolving credit card debt for extended periods of time while paying high interest charges. In March 2018, the government implemented the first phase of reforms in response to the Senate inquiry. It is hoped these reforms will help prevent future consumers from experiencing problem credit card debt by ensuring that credit providers assess a consumer's ability to repay a credit card limit over a period prescribed by ASIC, banning unsolicited credit limit increase invitations, and making it easier for consumers to cancel credit cards. ASIC also issued a consultation paper which proposes responsible lending assessments for credit cards be based on whether the consumer can afford to repay the credit limit within 3 years. The RBA left the cash rate on hold again in early July, but an increase in funding costs has led to some lenders raising home loan interest rates anyway. In its 6th meeting of the year, the RBA board agreed to leave the cash rate on hold at 1.5%. This was the 21st meeting in a row that the central bank has held rates steady. RBA Governor Philip Lowe noted that nationwide measures of housing prices were little changed over the past 6 months. He added that conditions in the Sydney and Melbourne housing markets have eased, with prices declining in both capitals. Housing credit growth has declined, with investor demand having slowed noticeably. Lending standards are tighter than they were a few years ago, with APRA's supervisory measures helping to contain the buildup of risk in household balance sheets, Lowe explained. Some further tightening of lending standards by banks is possible, although the average mortgage interest rate on outstanding loans has been declining for some time. The RBA governor added that the low level of interest rates is continuing to support the Australian economy.